From Informa Tech Target, I'm David Essex, and this is Enterprise Apps Unpacked. You've probably seen the buy now, pay later options at retail point-of-sale terminals and e-commerce sites. They're one of the products enabled by a growing industry in digital finance that provides the infrastructure banks and other financial institutions need to be able to service these loans and offer them on their own websites and smartphone apps. The Jifiti Group is one of the fintech companies behind this and other digital lending products. It makes a white label platform used by merchants like IKEA and banking customers that include Citi, MasterCard, and Citizens. It probably won't surprise you to know that AI could soon transform digital lending the way it's changing a lot of things. Vendors are exploring using AI to make the credit decisions currently made by human underwriters and non-AI algorithms. Like other kinds of AI automation, it could be a big opportunity for lenders and borrowers. But it also raises familiar ethical, legal, and compliance concerns. What happens, for example, if an AI digital lending tool is biased and denies loans disproportionately to minority groups? There's a trust issue. Users need to believe they can trust the AI to make credit decisions that are fair and mutually beneficial, now and in the long run. Our topic today is these AI-enabled digital lending systems, and here to discuss it is Yaacov Martin, Jifiti's co-founder and CEO. He explains how digital finance systems work, how people use them, and what happens when you add AI to the mix. We also discuss the technical requirements of adding AI, the regulatory and other hurdles banks need to overcome, and what a future of AI-driven digital lending could look like. What's in it for enterprises that aren't banks? Retailers and manufacturers can add an online lending platform to get more business from customers who might not otherwise be able to buy without a low-interest loan. Now AI could make the whole process go faster and at higher volume, and therefore generate more revenue. The AI can access customer buying histories to craft more appealing credit offers. You might also find your online business loans being expedited by AI. It's worth a listen. Don't forget to rate, review, and subscribe to Enterprise Apps Unpacked for the real story on the software that runs your business. Well, nice to meet you, Yaacov, and thanks for joining the podcast today from Israel.
It's great to be here. Thank you for having me.
Digital lending is something that I honestly didn't know much about until I heard about your company and this topic. So I'm curious, how widespread was digital lending before AI started being added to the mix?
Yeah, so digital lending is probably almost as old as the internet. The issues that have existed over time have mainly been with regard to the steps that you were able to perform in the digital manner and whether or not you were able to complete the entire process. And if so, how long did it take for any type of lender or bank or financial institution to actually render a credit decision? So there's definitely been the notion of lending going digital, but today I would say that it's almost the expectation. And then the question is, when you mix AI into it, how does that impact digital lending? So we'll probably dive into this a little bit later on because there are different aspects that AI impacts, both in terms of the lender and the capabilities that a lender in theory should have today when utilizing AI. But not only, AI impacts other areas of this business as well, and we'll try to touch on them later on during our conversation.
Great. Digital lending, back to that long-standing technology, as you say, before AI was added to the mix. What kinds of companies have been offering it?
So I would say that traditional banks and financial institutions definitely saw digital lending as a tool that allowed them to spread their wings and engage with sometimes existing customers and sometimes engage customers who were at that time not necessarily banking with the financial institutions. Fintechs, though, were really the ones who took it to the next level. I mean, fintechs who were in the lending business, their exclusive engagement was through digital means. And therefore, there was never a situation where a new customer came and met any representative of the fintech in any type of physical form. There was none. And therefore, the entire interaction was digital. Again, some of these fundamental differences had to do not only with whether or not a piece of the process needed to be completed in person, but rather how quickly that process was able to take place through the digital spheres.
So, who was the typical customer of this type of digital lending service?
I would say that until not very long ago, customers, private customers, consumers were the ones who already expected to be able to apply and receive a loan in a purely digital manner. That has almost become a default expectation just because so many other areas of our lives and financial transactional type of activities take place within the digital medium. And lending was no different. I would say that what was not expected or what lagged behind was digital lending for businesses. And that is because businesses didn't necessarily have the same type of expectation in terms of immediacy, but it also had to do with the ability or inability of banks, lenders, and any other type of a financial institution to underwrite businesses in real time. It's a lot more complicated in many countries to underwrite a business than underwriting an individual.
I'm realizing now that this is an overbroad question. What's the technology behind it? But really what I'm getting at in that question is the sort of general architecture. Like, is it always a third-party company, which I presume your company is, that major banks like, around the world, HSBC, Bank of America, et cetera, are buying and using? And then within the sort of provider level, what is the type of system that is handling all the transactions?
That's an excellent question. And as you, I think, prefaced, there are many, many different flavors to this answer, depending often on who you're speaking to and who the bank has decided to engage or not to engage with. And I'll try to actually answer this in a broad manner through my own private lens. And this speaks a little bit to our own evolution, but our evolution was very much impacted by the demand or the challenges that we came across. So the answer is that a financial institution, a bank, a lender does not necessarily have to engage a third party. However, we found that certain activities in this world of digital lending were very natural to the bank and others were absolutely not. Now, does that mean that they can't teach themselves new tricks or hire people in-house to take care of those areas that are unnatural to them? The answer is they can in theory. In reality, that doesn't always work as well. Again, I'll take a step back and I'll try to break up digital lending into three different components. If you really zoom out and you can take a look at a variety of lending products and lending activities, starting from consumer all the way to business, secured, different types of loans, one-time loans, revolving lines of credit, deferred invoices, and so on and so forth, there are a few common denominators. The one, and this is how we look at it, is the origination or onboarding stage. That is essentially the point in the process where the applicant for the loan is meeting the potential lender. And through that meeting, of course, an applicant has to disclose and give over many, many different data points so that the lender can make a credit decision and decide to underwrite or decline the application. That entire process we refer to as origination or onboarding, as I said before, and that is often an activity that in the digital medium needs to be able to collect data, sometimes verify that data, and based on that data, run it through an engine, and we'll speak about that in another bucket, And then ultimately, based on the credit decision, that origination process still has to take care of a whole bunch of things, like sign off on terms and conditions, like connecting a repayment method. How are you going to repay the loan, and so on and so forth. That activity is not always the DNA of a traditional bank. A traditional bank is generally very, very good at underwriting and has a very proficient team that can handle their risk and assess as to what type of loan or what type of application they'd like to approve. But reaching out there and creating all these different digital journeys is sometimes a little bit more difficult. It's not rocket science. It just happens not to always fall within the DNA of especially the traditional lenders. So that's bucket number one. Bucket number two is I'm going to jump to the very, very end of the process. Let's assume that an application was approved, the amount has been underwritten, and now those funds need to be disbursed, meaning I applied for a loan and I'd like to now make use of those funds that have been approved. Now, in some cases, that is very simple. It's a personal loan. It's going to be ACH'd or wired into my bank account, and we're done. But there are much, much more intricate or detailed or sophisticated type of loans today where those funds are not being sent to my own private bank account. Maybe those funds have been approved for a very, very specific transaction taking place somewhere else within a merchant or within another retail establishment, or maybe on some kind of other business ordering system. And in those cases, that activity of disbursing the funds and aligning them to the very, very specific terms and conditions of the loan can be a challenge in and of itself. That's a payments business. And believe it or not every lender is an expert at payments, especially not if those are digital payments. So that's bucket number two. And now we're going to go to bucket number three, which is, I think, much, much more detailed, complicated. And that is everything that has to do with the real-time underwriting of that loan. I kind of glossed over it before. I said, you have the origination process, you collect the data, you send it over to the bank or to the lender, and they render a credit decision. Rendering that credit decision is made up of many, many, many different steps, including things like know your customer or know your business or AML concerns or fraud concerns or even other types of regulations and other compliance factors that need to be taken into account. And some of those are, I would say, broad and essential pieces of underwriting. Some of them have to do with the credit decisioning, and some of them can be as simple, seemingly simple, as choosing the right type of digital platform that can be used for e-signature. Because again, you're not sitting in front of a banker that is handing you a pen and paper to sign your name on the dotted line. And that needs to be some sort of platform that is approved in many, many countries and jurisdictions. This has to comply with, like I said, the regulatory framework. And all of those different details or different capabilities, technical capabilities, are absolutely critical in order to perform real-time digital underwriting. And that is bucket number three. And we can spend quite a bit of time discussing it. I'll probably touch on it pretty soon. Some of those elements lenders have in-house. Some of them they do not. Some of them have to be replaced. Some of them have to be complemented by others. And that is where much of our activity lies.
Mm-hmm. So now that you've really set the stage, so to speak, of what digital lending is, what happens when you add AI to that mix? What are the new capabilities that it brings?
Okay. So let's start with the so-called simple AI application. I'm going to make a statement, and I stand behind the statement. The application of the statement is not as easy. AI does a much better job at decisioning, at creating a decision on behalf of the bank than any human underwriter can. That is very, very clear. Obviously, you need to train the AI. You need to feed the AI with the relevant data. You can't leave gaping holes in the data that you feed it. But if you feed it the same information that has been previously being fed to different non-AI engines and or human underwriters, you will get a better result. However, It doesn't mean that we can just replace all of underwriting with AI. Why is that? Because in many, many countries, such as the US, we have laws in lending that are there in order to ensure that there is no discrimination. And we as a society, and of course the law, need to uphold those principles in the shape and form of various type of acts, for example, truth in lending and others. When you put all of this information into an AI and the AI spits out a approval or decline, you have to ensure that you are still complying with all of those different regulations. Now, it doesn't mean that you can't dictate this to an AI, but it does become more difficult because of the way that AI operates today. Even those who are deeply familiar with the inner workings and underpinnings of AI will tell you that once the AI is trained, the AI is going to go ahead and produce the best result that it possibly can, sometimes trampling some of those principles. And that is something that regulators are concerned about, and that is something that compliance folks are concerned about, and therefore there are certain limitations today placed on the usage of AI for underwriting.
Go ahead. I think you have more.
I'm not going to go into the second piece, but I will reference it. There's another whole world out there that has less to do with the actual underwriting technology, but it has more to do with what we today call agentic AI. And that actually, believe it or not, has more to do with bucket number 1 of origination than it does with bucket number 3 that deals with the orchestration of underwriting. And maybe we'll get to it if I get the right prompt from you.
I'm wondering about where banks are in this with the AI part. In some of the writing that you've done online, you talked about the reluctance of banks to add AI to their lending. So I'm wondering, how widespread is AI adoption in the banking sector, especially for lending products?
Okay, so I'll try to break this down into a few different elements. When we previously, just a moment ago, spoke about AI and its value in assisting the underwriting processes, what we're looking at is both the automation. AI obviously is automated, immediate, spits out a result in milliseconds, and that's wonderful. And we also spoke about the value of AI in terms of its accuracy. It's able to give a better underwriting result or an aggregated better result for the lender in terms of defaults and repayments and so on and so forth. That, of course, is another tool that we would put into the category of efficiency. It allows banks and lenders to be very efficient. They don't have to bank on human capital. They don't have to wait for prolonged processes. And it has an actual financial efficiency because the underwriting is better, which yields a better bottom line for the lender or for the financial institution. The agentic AI that I referred to beforehand has much, much more to do with the engagement with customers or potential customers. What agentic AI basically means today is that it is not far off that I'm going to use any agent I choose. If I'm using today Claude, and I am starting to allow Claude to perform all sorts of tasks for me, not only summarize materials or draft and so on and so forth, but actually go ahead and book a flight for me or book a hotel room. I'm actually going to want to use Claude to find the best financing solution or loan for my next remodeling of my home. I will say to Claude, listen, I'm about to go on a remodeling mission. I've been quoted $25,000. Please go ahead and find me the best loan for the best rate that I will pay over the next 5 years with an interest rate no higher than whatever it is. Let me know when the funds are in my bank. You, Claude, have access to my digital identity. You can sign on my behalf. You can do all of that. Now, that's all true from a technological perspective. It's all there. We're able to do it. And then the banks and the lenders have to ask themselves, are they set up for that? If Claude or any other agent pings them for or surveys a whole bunch of different lenders in order to get the best product for me in real time, are their systems able to communicate with those? And what I do write about quite a bit is that we speak about the reluctance of banks, but the truth of the matter is that when you break all that down into components, the banks are often missing a lot less than they think they are in order to be able to cater to that type of situation. And the reason that I speak a lot about the absolute necessity of the banks to realize this is because when this shift happens, if they are not prepared to respond to these type of agents, in that context, they will disappear. They will evaporate. It was like I always give the analogy of the early days of search. If you weren't indexed, you didn't exist.
Right. Yeah. So I think you've alluded to this. Are the two main concerns from banks whether they have the systems and, let's say, processes in place, but then also compliance? Is that it? Or are there other things that they're really nervous about having to get right before they add AI to this process?
So both of the points that you mentioned are true. And then I think that there's another layer around all of that. There's quite a bit of, I would say, confusion and sometimes apprehension when it comes to AI. When you speak to many of the bank executives, they know it's rushing in. They, as private people, engage with AI and so on and so forth. And they know that there are revolutions happening now and revolutions around the corner. And the problem often I find in my conversations with them is that everything is jumbled together and very nerve-wracking, overwhelming. And I often find that through our conversation, when we break things down into elements, then the anxiety, first of all, relaxes itself a little bit, and we are set up in a way where we can start tackling some of those areas. I'll give you an example. There is a very, very large international bank that we have quite a few dealings with. And we've spoken to some of the execs who are constantly telling us that within their annual planning, they are being tasked to reduce their expenses significantly with the usage of AI in all sorts of departments, operational and so on and so forth. And they seem to see that as the be-all and end-all of AI. Now, it is true that AI creates efficiencies. The problem is that when we speak about other areas of AI, it has very little to do with efficiency. Like I said, I gave the example of agentic AI in the context of digital lending. It has to do with access. Whether or not customers will or won't have access to the bank, whether banks will or won't have access to these customers when agentic AI takes over. Now, it is great to think about reducing cost, but if you ultimately stand to lose the entire market segment or a big piece of that market segment, then reducing your costs won't cut it. You have to figure out how you maintain and enhance the traffic coming into your institution. And then the other piece that I find that often creates this overwhelming feeling is they speak about, I need to go through all of my systems and turn them into AI enabled. And when we start breaking things down, they actually find out, no, I actually have many of the components that are absolutely necessary and even up to par in terms of the ultimate AI agent, meaning if I put them all together and wrap them with a layer of AI, I'm actually where I need to be. And the gap isn't as huge as I originally thought it was. Now, once you get all of that clarity in place, you are right that there are compliance concerns, et cetera, et cetera. But those folks are getting on board quickly.
Can you walk us through the experience that the end customer would go through using one of these services, especially the parts where AI gets involved?
Yeah. So if we're speaking about AI in the first version of the AI that has been implemented properly for assistance in underwriting, the customer really doesn't feel much at all. What the customer may get is a quicker credit response, but the efficiencies are really taking place on the lender's side. And the benefit to the customer is ultimately the fact that the customer will receive that immediate digital response. Sometimes, I think in the longer term, it can even reduce the cost, because obviously when your underwriting isn't as exact, then you may have to build in another buffer in order to, on average, offset your defaults. And if we reach a stage using AI where underwriters are able to give a more accurate type of credit response and rating, ultimately it can bring the price down for the customer as well. So that's kind of number one from a customer experience standpoint. Now, if we already venture into the agentic AI world, then the experience is transformed for the customer. The customer no longer has to create market research, doesn't have to survey the different offers. It is all done machine to machine through an agent, where the agent applies on its behalf, on the customer's behalf, possibly to multiple different vendors or lenders, and really picks and chooses the most appropriate couple to apply to. And then, again, this is all done in real time. So you essentially could very soon be in a situation where you send your AI agent to go and get you a loan, and 3 minutes later, it's in your bank account.
It seems like this kind of lending option is starting to show up more in digital payment systems and e-commerce sites, rather than just straight payment, but actually, and I'm not just mean credit cards. Where do you see the next big opportunities in where lending is going to show up?
Okay. So I think what we're seeing over the last 12 months is we're seeing the whole world of business lending really coming alive. And I think that's happening for a couple of reasons. Number one is consumer lending is not a red ocean, but it's definitely been evolving and expanding digitally a whole lot faster. And we referred to this at the beginning of our conversation, a whole lot faster than digital business lending. And business owners who are also consumers themselves have slowly begun to expect this for their businesses. Their business needs have become more immediate. Some of the examples I give are small and medium businesses who are now planning inventory and possibly placing an order through some sort of system. And today, if their only method of payment is essentially cash, even if they're paying it off a credit card or some other kind of transfer, but essentially they're not really getting extended credit on that payment, then that impacts their inventory planning. But if they have a clear and present option for financing within that checkout or the payment methods that they're using, that can really impact their ability to plan properly and stock up, or whatever the context may be for that business. That's one area that we see developing very quickly with tremendous opportunity, because we're speaking about a segment that hasn't really been served digitally in real time with these type of options built into their day-to-day activities. So I think that's one. I just came back from a meeting where the application became very, very clear in a completely different consumer context. I was meeting with a very large entity that runs a very, very popular peer-to-peer payment application. They have been wildly successful at making it as easy as possible for me to send you $100 because we just went out on some outing and you paid for us all. It's become so successful that small and medium businesses are using it to pay and get paid. Insurance companies are using it for payouts. But this is all happening peer-to-peer. Now, the average transaction amount is constantly going up. but there are no ways to spread that into payments. So if I need to if that's going to be my choice of payment, but I have absolutely no way to spread those payments, I am then confined only to the cash I have at present. And again, that hinders the development of many of these ecosystems. And I think that's an area that we're going to see more and more, even in peer-to-peer, the ability to split that into payments, pay over time, make significant transactions through these platforms, and really allow these platforms to evolve from being a how do we split this pizza payment into how do I use this in my day-to-day larger financial transactions.
So the majority of listeners to this podcast are probably business and IT decision makers in corporations. They're not technology vendors or banks, but they're the customers of vendors and banks. So they're probably not looking at AI lending the way a bank would, but I'm wondering if they should be. How could this technology change how they do business?
So I think that what we're finding now is that AI is almost a buzzword that includes many, many, many different components. The AI is able to aggregate all of these different functions, data points, often provided by these third parties that are listening to us today, and then come out with a result, come out with a better credit decision, and so on. And I think that what we all need to be thinking about, because I'm probably one of many, in this case, listeners, we have to understand that all of our functions and all of the value that we bring through our various, whether it's software solutions or other, need to be able to tie in to many of these AI capabilities that essentially are taking sometimes hundreds, thousands, millions of different data points or other values. And as long as we make sure that we are flexible enough, it's almost like the API days. So now, yes, it may still be using APIs, but in order to allow for these LLMs to aggregate these data points and the other values that we bring and really spit out that type of result that we said before is faster, is more accurate, and so on.
In your newsletter on LinkedIn, which is called Lending Intelligence, and I love the double entendre, by the way, I picked up on that a little later. You wrote that many banks already have the digital finance infrastructure they need to add AI lending. And you've kind of alluded to this a few times already in our discussion. So what specifically do they need for the AI part? Can it be embedded in an existing system in some way, or do they have to run it on a separate platform that's maybe linked into their lending platform?
Yeah. So as I mentioned, we believe and have practiced this with many of our partners and clients, where many of those fundamental building blocks exist. They need the right type of, sometimes it's an external partner, sometimes they may even have those internal people who have the experience and capabilities to draw up the architecture that leverages those existing building blocks and ties them in through some of the means that I mentioned before into these layers of AI that are consuming the data or the values that are coming out of those building blocks and able to process them through the AI mechanisms. Sometimes it makes more sense for them to actually separate it out completely. It really does depend on what they have set up at the time. But the point that I constantly find valid every time we assess one of our partners to try to assist them with this migration into the world of AI is that they have much, much more than they initially think that they do. And it's, like I said before, some of it has to do with reducing the anxiety just by creating a map and the clarity of what is needed and what the gaps are. And you find out the gaps aren't as big. And then, of course, as you mentioned before, bringing the compliance people on board. And the more visibility and the more clarity that you're able to offer, as opposed to a black box called AI, the more cooperation you'll get from the compliance people. I can tell you, even internally within our company, the quick evolution of our compliance team in terms of what it allowed and didn't allow our internal staff to use in terms of AI tools. And, this was relevant for salespeople and for programmers and for QA folks and for operational folks and customer support and so on and so forth. The more clarity they got on what this involved, the easier it was to get it through the green line and get it approved by them.
So which components of all this that we've been talking about, I guess, of the architecture, does your company, Jifiti, provide?
Let me start with what we don't provide. We actually are not in the business of creating new AI agents or new AI layers. We find that there are wonderful companies out there that do it. What we are able to do is we are able, number one, to map out in terms of the automation of lending and later how that feeds into the AI engines. We're able to map that out with our partners and figure out what they have and what the gaps are. We're often able to fill those gaps, and those gaps we actually fill sometimes with our homegrown technology and solutions that we've developed over time. And many times we fill those gaps through third parties that are plugged into our own orchestration layer. We have about 50 third parties, and very, very happy to speak to your listeners and to other entities who provide any of those blocks in the value chain. I can tell you those include today things like KYC, KYB, AML, fraud, decisioning, e-sign, open banking, a whole series of elements that today exist in the world of digital lending. And once we map out what our partners have, what they're missing, and how we plug those holes, then we're able to collaborate either with their internal AI folks, if they have those, or sometimes the external, and usually it is external AI companies that they're looking to engage with or already engaged with to really ramp up and revolutionize their stacks.
So aren't there some pretty big security and AI trust issues? And maybe most of that trust is on the lender side, but it occurs to me, the customer needs to trust it all too, that are really important to address to really make this happen.
Yeah, that is absolutely true. And I will say that that is developing very, very quickly. The different versions of existing, even popular AI brand names into subsegments that are limited, closed off to certain environments for security reasons, or sometimes even just whether or not various entities are looking to share their data with the broader LLM. Those are capabilities that already exist in many of the large-scale AIs. And we're finding that is actually catching up very, very quickly to the standards that, for example, the banking world insists on. You will find more and more banks today who are using versions of the popular AIs in-house because they are using a version that isn't open to the rest of the world. And that helps enhance security and really cater to these type of concerns.
What's your longer-term vision for how digital finance systems, especially the lending services, could evolve if providers adopt more AI-driven lending? In other words, what this world look like in, say, 10 years from both the consumer and the provider standpoint?
So number one, I think that we will find that lending activity will be more tailored towards the transaction at hand and the applicant, which I think will benefit both sides, meaning lenders will be able to lend more accurately. And like I said before, customers ultimately will also benefit from, I would say, accurate pricing. So that's number one. And I think number two, in terms of the immediacy beyond the credit decision, the whole notion of ours today that, I have to apply for a loan, I have to apply for finance, is going to change entirely. If I'm creditworthy, then all of those options will be served up to me whenever I'm at the point of need. Of need doesn't necessarily mean that I'm financially in need, but I am in need of various financing solutions for a specific type of activity or transaction. That is no longer going to be perceived and acted upon as a task. It's just going to be built into the various payment methods that are available to us throughout our financial activity. And what that can do to financial activity altogether is mind-boggling.
Yeah, you can really see the potential for automation, and it's a qualitative, not just quantitative difference in how things are done.
Exactly. I think that's the real shift that we're about to see. It's not just a matter of faster and better and so on and so forth. It really changes the way we think about possibility in the financial world.
Well, Yaacov, this has been fascinating, and I appreciate that you've given our listeners all such great detail about how this all works. Thanks for coming on the podcast.
Thank you for having me. This has been a pleasure.
Thank you for listening to Enterprise Apps Unpacked, where we give the real story on the software that runs your business. To learn more about business applications, explore our content on searcherp.com. Find us on YouTube at our channel, Eye on Tech. Subscribe to our podcast to receive the latest episodes as they drop. And if you liked what you heard today, give us a rating and review on Apple, Spotify, or wherever you're listening. Until next time.
Podcast programming and promotion by Kelsey Waddell. Music supplied by DP via Getty Images.